What triggers doing business in Canada from a legal standpoint? For many US businesses entering the Canadian market, the biggest point of confusion is the definition of doing business in Canada. Canada does not use a single test or formula. Instead, it evaluates a combination of commercial, tax, and operational indicators. The decision matters because once your company is considered to be doing business in Canada, several legal obligations may follow, such as extra provincial registration, GST HST accounts, payroll obligations, or even corporate tax filings. Understanding these triggers early ensures your business expands smoothly and compliantly. No single rule, multiple tests apply. Unlike the US, which often uses a clear nexus test, Canada evaluates a wide range of factors. The courts, the CRA, and the provinces each assess business presence differently. Two questions matter most. Where is the value actually created? Where are core business activities performed? A company may have no office in Canada and still be considered to be doing business there. Physical presence is the strongest indicator. Any sustained physical activity in Canada is a major trigger, including employees working in Canada, contractors performing services, technicians or specialists conducting on-site work, maintaining an office, desk, or workspace. Physical presence almost always requires provincial registration, but physical presence is not the only trigger. Certain non-physical activities also qualify as doing business under Canadian law. Solicitation and targeted marketing. While passive marketing, e.g., a website accessible from Canada, does not constitute doing business, targeted and organized solicitation may. Examples include Canadian targeted ad campaigns, local sales representatives, attending trade shows to sign contracts. Outbound sales activities directed at Canadians. If marketing efforts are deliberate and ongoing, provinces may interpret this as doing business locally, even without physical presence. Using agents or representatives in Canada. If a Canadian agent regularly negotiates or concludes contracts on your behalf, you may be considered to be carrying on business in Canada. This can trigger GST HST obligations, extra provincial registration, potential permanent establishment exposure. The location of work, not the location of the corporation, is what matters. Digital services and online platforms. Canada's modern GST HST rules treat digital service providers similarly to physical service providers. If your digital product is purchased and consumed by Canadian residents, you may be considered to be carrying on a taxable activity in Canada. Digital activities that may trigger obligations include SaaS subscriptions, paid online training, digital downloads, membership programs, online consulting delivered to Canadian residents. The service is considered supplied in Canada even if created elsewhere. A practical example. A US environmental consulting firm conducts all research from the US, but sends specialists to Canada twice a year for field inspections. Although limited, these visits represent core consulting work happening on Canadian soil. The firm may be considered to be doing business in Canada, requiring GST HST registration and provincial registration, despite not having an office in the country. Final thoughts. Doing business in Canada is defined by activity, not location. If meaningful business operations occur on Canadian soil, or if digital services are delivered to Canadian customers, your company may have legal obligations. Understanding these triggers early prevents compliance gaps, tax exposure, and costly registration delays. If you'd like more insights delivered in the same straightforward style, you can explore our website. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.